Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
It's great to be back. And, looking at the stack of reports on the desk today, we've got Bloomberg, CNBC, Yahoo Finance. I don't think I've seen a market quite this pulled in two different directions in years.
We really do. We have a lot to unpack. Today is Thursday, January 29, 2026. And I want to start by, addressing the feeling a lot of you might have had glancing at your phones this morning. You see that top line headline, Federal Reserve holds rates steady? And you just think, okay, boring day, business as usual.
Right. On the surface, it seems like a total non-event. But if you actually dig into the meeting minutes and the analyst notes we have here, business as usual is, well, it's the last phrase I would use.
No, not boring at all.
No, this was a chaotic, even historic day in the markets. That calm headline is masking a massive storm right underneath.
And that's really the theme for today, isn't it? The fractures right beneath the surface. We're looking at a Fed meeting that, on one hand, looked boring, but on the other, revealed these deep internal divisions. And it's all operating under this cloud of just unprecedented political pressure.
And at the exact same time, you have commodities, gold, silver, copper, absolutely melting up. I mean, shattering records in a way that some analysts are literally calling broken.
And then there's the stock market, specifically big tech, where that old idea of an AI rising tide lifting all boats, well, that's over. We are seeing a brutal divergence, real winners and real losers.
A huge divergence.
So let's get into it. We have to start with the Federal Reserve. As we said, the headline number is steady. They held interest rates in that 3.5% to 3.75% range.
Right.
But you flagged a detail, I think it was in both the Yahoo Finance and CNBC reports, that just completely changes the contest. This wasn't a unanimous yes, was it?
No, and that is the critical takeaway here. For the longest time, the Fed has projected this completely united front. But yesterday, the dam cracked. We saw dissent.
From who?
Governors Stephen Miron and Christopher Waller, they actually broke rank. They voted for a 25 basis point cut.
Okay, so for listeners who don't speak fluent central bank, why is a dissent over just 25 basis points such a big deal?
Well, a basis point is just 1/100%, so it's a tiny cut. But the reason it matters isn't the size, it's the signal.
The signal.
Exactly. When you have governors dissenting, it means the data isn't clear anymore. The majority, led by Chair Powell, is saying the economy's solid, we can wait. But Miron and Waller are basically shouting, you are wrong, we are waiting too long, and we are going to break something.
So that higher for longer narrative is now getting pressure from inside the building.
From inside the house, exactly. It signals that the consensus is fragile. If the labor market softens even a little bit more, that dissent could very quickly become the majority opinion.
Now, speaking of Powell, he gave his press conference. I was reading the transcript from Yahoo Finance, and he seemed pretty, adamant about holding the line. He said a rate hike is not anybody's base case.
He's trying to project confidence. He has to. He mentioned the labor market is stabilizing, which is the good news. But he also used a term that I think we really need to pay attention to. Tariff inflation.
Right. That's a buzzword we've been seeing more and more. What's his specific take on it? Because we all know tariffs have been ramping up.
So Powell's argument is that this is a one-off. He expects a jump in prices because of the new tariffs, but he thinks it'll top out by the middle of 2026.
One-off.
He's basically betting that this is a temporary price spike, not the start of some long-term inflationary spiral where prices just keep going up and up.
That feels like a very risky bet. If he's wrong, and that temporary spike becomes permanent, the Fed is in a really, really tight spot.
It is an incredibly risky bet, especially when you see what commodities are doing, which we'll get to in a minute. But before we leave the Fed, we have to talk about the elephant in the room. You can't read the CNBC Daily Open or the Yahoo Finance coverage without seeing this massive political shadow hanging over the whole meeting.
Oh, it's impossible to ignore. This isn't just about economics anymore, is it? It's about the legal survival of the institution itself. I mean, you have the Supreme Court case over President Trump's attempt to fire Fed Governor Lisa Cook. Powell actually commented on this, didn't he?
He did, and his language was stark. He called it, and this is a quote, arguably the most important legal case in the Fed's 113-year history.
Wow.
Think about that. He isn't talking about interest rates or jobs. He's talking about whether the central bank can even exist as an independent body. If a president can fire governors at will, well, the markets lose all faith that the Fed is making decisions based on data.
Well, just think it's all politics.
It all becomes politics. And as if that wasn't enough, Yahoo Finance noted this was the first meeting since the Justice Department disclosed a criminal investigation into Powell himself.
I mean, can you imagine trying to chair a meeting on global monetary policy while the DOJ is investigating you?
It just adds this layer of complexity and, frankly, a risk premium that markets absolutely hate. Markets can deal with bad news. They can't deal with uncertainty. And right now, the Fed's leadership is just shrouded in uncertainty.
I saw Powell gave some advice to his successor, whoever that might be.
Yeah, he said, don't get pulled into elected politics. Don't do it.
Which sounds less like advice and more like a plea.
It's a plea for the future of the institution. He knows the wolves are at the door.
So, if we boil this all down, the Fed is trying to look stable by holding rates, but internally they are split, and externally they are under what may be the biggest political and legal siege in their entire history.
Precisely. And this is where the story connects. Because markets, they can smell that fear. When investors doubt the stability of the central bank and its currency, they run. Which brings us right to our second pillar, the absolute explosion in commodities.
Okay, this is the part of the research that really made my jaw drop. I was looking at the Bloomberg and CNBC numbers. If the Fed meeting was steady, the commodities market was completely, well, unhinged.
Unhinged is a polite way to put it. I saw several analyst notes we reviewed that used the word broken.
Let's hit the hard numbers, just so everyone listening understands the scale we're talking about. Gold didn't just break a record. It surged past $5,500 an ounce. It hit $5,595.
And just to put that in perspective, a few years ago we were all watching $2,000 as this major ceiling. We're nearly triple that now.
And it's not just gold. Silver crossed $117 an ounce. The data shows it's up 145% in 2025 and another 65% just to start 2026. And copper, over $14,000 a ton. What on earth is driving this? Can't just be people making jewelry and wires.
No way. You cannot explain a move of this magnitude with industrial demand. Bloomberg has a term for it that I think is essential for everyone to understand, the debasement trade.
Okay, let's unpack that. Debasement trade, it sounds ominous. What does it actually mean?
Think of it like a seesaw. On one side, you have paper currency, the US dollar. On the other side, you have hard assets like gold and copper. The debasement trade is the fear or the realization that the paper currency is rapidly losing its value.
So investors are fleeing.
They're fleeing currencies and bonds because they're terrified of government debt, geopolitical instability, and that lack of Fed independence we just talked about.
So when we see gold going through the roof, it's not necessarily that gold is becoming more valuable. It's that the dollar you use to buy it is becoming less valuable.
Exactly. It's a vote of no confidence in the dollar. The U.S. dollar index is at a 4-year low. And interestingly, President Trump was quoted saying he is not concerned about the weak dollar. Well, if the president isn't worried about the currency holding its value, investors feel like they have to be.
They need something that can't be printed by a central bank.
That's it. So they rush into hard assets.
But is this rational? Because I was reading the CNBC report, and I saw quotes from analysts asking if the market mechanics are even functioning properly anymore.
And that's the liquidity side of it. Nikki Shields from MKS PMP called the volatility unheard of. And Maximilian Tomei suggested that prices are just becoming detached from fundamentals.
Detached how?
Well, normally price is discovered by a balance of buyers and sellers, right? Right now, it's just being driven by a flood of money looking for a home. It's speculative cash piling in because it doesn't want to be in dollars.
It creates a vacuum.
A vacuum effect where prices just gap up violently. You saw that crazy detail in the Bloomberg story, China's metals mania. Copper jumped 5% in less than an hour.
At 2:30 a.m. London time.
Exactly.
That is not a factory in Michigan ordering copper for next month's production run.
No, that is a clear signal of Chinese speculative funds piling in during their trading hours. It's a stampede. When you see a 5% move in a major commodity in 1 hour during off-peak times, that's algorithmic panic buying.
So there has to be a risk here.
Oh, a massive risk. And I have to be the voice of caution for anyone listening who's thinking, I need to go buy gold right now.
What's the downside?
The technicals are screaming bubble. We look at something called the RSI, the Relative Strength Index. Think of it like a speedometer for a stock. Usually anything above 70 is overbought.
And where is gold right now?
The RSI for gold is above 90.
90.
It's extreme. It suggests we're in a vertical move that could face a very sharp crash or a technical adjustment. When things go straight up, they usually come down just as fast.
So the message is,
Yeah.
the underlying fear is real, but the price action itself is getting manic.
Exactly. And that manic energy isn't just in rocks and metals. It's changing how people look at the stock market, too, especially AI. Which brings us to our third pillar.
Right. This is where it gets really interesting for anyone picking stocks. For the last 2 years, the strategy was simple. If a company said AI on their earnings call, you bought the stock.
It was a magic word.
It was. But looking at these earnings reports from Yahoo Finance and Bloomberg, that era is over. Investors are getting incredibly picky.
The rising tide lifts all boats phase is done. We are now in the show me phase, and we're seeing this massive split between the winners and the losers.
Let's start with the winner, Meta. Their stock is up around 7%, but here's what confused me at first. They announced they are spending an absolute fortune, $135 billion for AI data centers this year alone. Normally, the market hates that kind of spending. Why are they getting a pass?
It all boils down to narrative and trust. Mark Zuckerberg promised a rapid trajectory for their models. The market is looking at Meta and saying, okay, you are spending a ton, but we see the path, we believe you can do it. They're rewarding the aggression because they trust the execution.
Now, contrast that with Microsoft. They're down about 6 or 7%. Microsoft has been the golden child of AI. What went wrong?
It's a game of expectations. Microsoft's report showed that cloud growth slowed. Now, Azure revenue was up 38%, which is an amazing number for a company that size.
Yep.
But it was slightly slower than the prior quarter.
So the formula is high spending plus even a tiny hint of slowing growth equals very unhappy investors.
That's it. If you're going to spend billions on infrastructure, you cannot show even a hint of a slowdown in the payoff. The bar is that high now. Perfection is priced in.
And then we have the disaster of the day, SAP.
The German software giant plunged 14%, their biggest one-day drop since 2020.
And the reason was their cloud backlog.
Yeah. They were expected to grow 26%. They got 16%. In this environment, that is a massive miss. And it just shows that not everyone is winning this transition. Just because you're a tech company doesn't mean you get a free ride on the AI train.
You have to deliver.
You have to deliver. If you can't show you're capturing that demand, you get punished.
There's another layer to this AI story that I found fascinating. In the hardware world, we talk about NVIDIA all the time, but the CNBC and Bloomberg reports highlighted a changing of the guard in memory chips.
This is a huge shift in the industry hierarchy. We're talking about SK Hynix versus Samsung.
And Samsung has been the titan of memory for decades. But the reports say SK Hynix has beaten Samsung Electronics in operating profit for the very first time.
They bet the farm on a specific technology called HBM high bandwidth memory.
Okay, can you explain HBM for us? What makes it so special?
So think of a standard memory chip, like a single-lane highway. It can only move so much data at once. HBM is like stacking 10 highways on top of each other.
Wow.
It allows for massive amounts of data to flow instantly, which is exactly what NVIDIA's GPUs need to run these huge AI models. SK Hynix mastered this niche early. Samsung is now playing catch-up.
I saw Samsung is actually buying back its own shares just to stop the bleeding.
They are. It's a defensive move. And it highlights a bottleneck that Elon Musk actually mentioned in our source material. Bloomberg quoted him saying, "We're going to hit a chip wall if we don't do the fab."
A chip wall. That sounds bad.
It means we have all this demand for AI Meta spending its $135 billion, everyone building models, but we physically might run out of the advanced memory chips needed to run them. That physical constraint is what is making SK Hynix rich and leaving Samsung scrambling.
It's amazing how physical the digital economy really is. It all comes down to copper wires and memory chips.
It always does. The cloud is just a building full of hot metal somewhere.
Now, speaking of the physical world, we can't wrap this up without looking outside the U.S. There were some serious geopolitical flare-ups mentioned in the sources that are moving markets.
Right. We have to talk about oil. Brent crude is climbing back towards $70 a barrel.
And Bloomberg attributes this directly to President Trump, right?
Yes, he threatened speed and violence against Iran if a nuclear deal isn't reached.
Speed and violence. That is very direct.
It is, and traders are reacting by buying up call options on oil.
Explain that trade. What's a call option in this context?
It's basically an insurance policy. Traders pay a small amount now for the right to buy oil at a certain price later. If war breaks out in the Strait of Hormuz, where a huge chunk of the world's oil flows, prices would just skyrocket. They're betting on or hedging against that explosion.
That geopolitical risk is back in the price.
It's back. And then, jumping over to Asia, there was that startling event in Indonesia. CNBC reported the Jakarta Composite Index crashed 8%, and they actually halted trading.
That's a massive move for a whole country's index.
It is, and it's a cautionary tale about liquidity. This wasn't about a bad earnings report from one company. It was about market structure. MSCI, they're a major index provider. They decide which countries go in which basket for investors. They warned they might downgrade Indonesia to frontier market status.
Ouch. That's like getting kicked off the varsity team.
It is exactly that. And Goldman Sachs immediately downgraded them to underweight. When these big institutional levers move, the money just leaves. Instantly.
It shows how fragile some of these international markets really are. We get so focused on the U.S. melt-up in AI and gold that we forget how quickly the floor can just drop out somewhere else.
And it connects right back to our theme. The money is moving fast, it's leaving risky places, it's leaving paper currency, and it's piling into what it thinks are the winners, U.S. AI tech and hard assets.
Okay, so bringing it all together, a lot of moving parts here today.
If we boil it all down, the picture is actually pretty clear. You have a Federal Reserve that is trying to hold the line and project calm, but the market isn't buying it.
No, the dissent proves that.
Right, so you have all this speculative money flooding out of fiat currency and bonds because of this debasement trade. And where is it going? It's going into metals, betting against the dollar, and it's going into these pure AI plays like Meta and SK Hynix betting on the future.
And it's leaving behind anything that looks weak, whether that's a legacy tech company like SAP that can't keep up, or a whole country like Indonesia facing a downgrade.
Exactly. It's a ruthless rotation to the extremes. Hard assets and hypergrowth tech. Everything in the middle is getting squeezed.
So for you, listening at home, especially for learners out there, the lesson today is to look past the headline numbers.
Right. Don't just look at the S&P 500 at the end of the day. The real story is this rotation. The debasement trade isn't just a finance term. It's a behavior. It's investors saying, I want things that are real, whether that's a physical bar of gold or a data center that powers the future.
And that leads us to our final thought. We always like to leave you with something to chew on.
We mentioned earlier that one analyst called gold the anchor of all valuations. So if gold is the anchor and the anchor is skyrocketing, what does that say about the ship?
That is a scary thought.
Mm-hmm.
If the measuring stick itself is changing that fast, what is the real value of the cash sitting in your pocket right now?
It's a question worth asking yourself as you look at your portfolio today. Are you holding the anchor or are you just holding the rope?
On that cheerful note, we have covered the Fed, the metals melt-up, the AI wars, and the geopolitical hotspots. There's never a dull moment.
Never.
We'll see you all tomorrow morning with new headlines from major financial magazines.